Thank you, everyone, for joining us today. I'm Daniel Coca, one of the co-founders of Alpha Investing, and I'm excited today to be here with Kevin Kasif, the founder and president of Titan Real Estate Group. Alpha Investing has been investing alongside Kevin for about a decade now, done a number of transactions together, and we're going to use this webinar to take a deeper dive into the senior housing asset class and talk a bit more about why we think it's a really compelling time to be acquiring senior housing assets. And so, Kevin, thanks for being with us. To get started, could you introduce yourself, give us a quick overview of yourself and your firm?
Thanks, Daniel. Yes, my name is Kevin Kasif. I am the president and founder of Titan Real Estate Investment Group, which was Titan's been investing as a private group over 2 decades. It's a private investment firm initially focused on multifamily office industrial. But about 12 years ago, we saw a tremendous opportunity in senior housing. And that's when we created our operating arm, Titan Senquist, to focus exclusively on this sector. Today, we own 30 different senior housing communities across the country with a particular emphasis on independent assisted and memory care. We do not do development. We do not operate in the skilled nursing area. We're vertically integrated, very hands-on because in this space, operations are everything.
And so we'll talk a bit more about operations, but really quickly, so you mentioned that you didn't start in the senior housing asset class. What drew you to the space, and how were you able to grow your platform to include those 30 assets?
Um, It was a combination of demographics, long-term demand, and the opportunity to create value through better operations. When you invest in industrial and multifamily to a certain extent, a lot of what you're doing is you're buying with a hope that interest rates stay low and cap rates stay low, and you can whatever you're going to do, you can sell it to the next person and make money, maybe get some cash flow in between. Senior housing is very different. Here, it is very much a hands-on. So you can separate yourself from your competitors by doing a better job, by operating at better efficiencies, having a better culture in your community. So we just realized early on that many senior housing assets were being managed like real estate. Um, but they need to be run like a business, and that disconnect created the opportunity.
And so, given I think most people that are familiar with the asset class know that the operating component of senior housing is very important. Why do you think that that's the case? And then when you went about, kind of building an operational team, how do you think about that?
Um, well, first of all, we got into it because we saw the compelling reason, the demand, some of those things. But just because you like that area doesn't mean you have the expertise. So we went about hiring what we consider to be top tier regional operators, individuals that were operating on that side. So that became the nucleus of our Titan Senquist. Um, Unlike multifamily, where property management is relatively passive, senior housing is a 24/7 hospitality and care business. You're managing meals, housekeeping, activities, and sometimes care. And it's a deeply personal to the residents and their families. Um, so we brought in this seasoned team from both hospitality and healthcare early on. And then we built out Titan Senquist to centralize systems, improve training, create consistent resident experiences. Economies of scale matter from food procurement, staffing models, insurance, and we've worked hard to align our operations to support that growth.
Yeah, I think one of the things that we've always really appreciated about the asset class is that it does reward better operators, whether that's by creating an environment that leads to, higher occupancy or being able to keep expenses in line, better than the smaller mom and pop operator. Like there is the ability, as you mentioned, to create value through operations and not effectively leave, the outcome of your investment up to what's happening in the market or
Right.
whatever you can control, right? So let's talk a little bit more about the fundamentals of senior housing. So for people who are less familiar, how is it different than another residential asset class like multifamily?
Oh, I think it's night and day. I think with multifamily, you're renting space. With senior housing, you're providing a lifestyle, service, and sometimes care. It's a much more complex operational model, but also one that, when done well, can create strong cash flows and durable demand.
And what are some of the things that people misunderstand most about the senior housing asset class?
Um, Well, I think that probably the simplest thing that usually people that are not familiar with the area is they think it's housing for older people. In reality, it's part healthcare, part hospitality, part real estate, and it's this interplay of those elements is where success lives or dies. Investors often underestimate the operational intensity uh, and overestimate the ease of lease up.
Yeah, I think that's a really important part of it. I remember, in the early part of COVID, there was a large number of traditionally multifamily acquisitions groups that were trying to get into senior housing, basically saying, well, why would I buy a five cap apartment building when I can buy a seven cap assisted living facility? And, we saw a lot of those deals come full circle on the back end where, those groups realize you just can't throw a third party operator
Right.
in place. Like you need vertical integration and you need to be operationally focused. And so that definitely makes a ton of sense to me. What about on the demand side? Was your investment thesis more demographic based? Do you look at things market by market?
Um, well, demographics are the tailwind because we're just at the front edge this year of the baby boomer wave. The number of baby boomers turning 65 is expect to rise rapidly until 2030. Um, so with the market selection then is critical. I think that we look for favorable supply demand dynamics. Income qualified seniors. We are only looking at private pay. We're really trying to minimize the amount of Medicaid that's in our building because that's a different model of just maintaining expenses. We're trying to do better facilities, better communities with more activities. So when we look at an area, what's important to us is you have to have the demand drivers. Are the number of seniors in those markets growing? Is the income there? Is there limited new development coming on? All those things are going to basically be put into a bucket and decide that these areas we want to be. Um, so even though I just said the thesis is demographic, execution is still hyperfocal, hyperlocal for us.
And then what are the industry expectations in terms of supply or development of new units versus, demand for those units?
Um, well, your two biggest um, data, I guess drivers would be NIC, which is the senior housing um, I guess, pack or data accumulator. CB Richard Ellis, a very well-known real estate brokerage, does a lot of research. They're expecting a material supply gap through at least 2030, as I described. Development That actually has been going on since about, let's say, 2017, 2018. But with COVID in 2020, any development really slowed to a crawl, and that crawl hasn't increased. Post-COVID, let's say we came out of COVID around 2022, as you know, construction costs have gone through the roof. Metal, labor, wood, all those type of things. So we have not seen, we saw a number of communities started but haven't been finished, which is nice. So that's where and maybe we add one more thing to that is financing costs are up. So you have those financing challenges, but the whole while that demand is increasing, and that imbalance will benefit groups like us that are existing operators and not looking to develop in the future.
So there are different types of senior housing, independent living, assisted living, memory care, skilled nursing, combinations of, two, three, even all four of those. What are you most focused on, and what is it about maybe a market or a deal profile that you try to avoid?
Right. Well, first of all, let's define what we're talking about because maybe not everybody knows. Independent living is really a senior apartment that we would supply food, which would be 3 meals a day. It would have activities. There usually be a bus to transport people to whether it's to go shopping or to doctor appointments. There's a sense of community. It is a lifestyle change, and it usually would be when, let's say, a husband has passed away and the kids don't want mom to be alone in the house. That's a lot of, I think people could understand that. The next step up in the acuity chain would be assisted living, where it's very similar to independent living, but we have some nurses there. So everything that I just talked about, independent living, would apply to assisted living, plus there'd be some care on the healthcare side. So it would maybe it's helping with medication or light type of healthcare needs. And then the third one up that we deal with is memory care, which is everything that's involved in the assisted living, but it also deals with somebody who has a much higher level of acuity needs. So therefore, the amount of staffing is increased substantially. What they're typically in a set areas because there's a wander risk. Anything that goes with Alzheimer's, dementia, memory loss, where they're protected and kept safe on a 24-hour basis. So now that we've defined what these different areas are, we'll focus on independent, assisted, and memory care. We are going to avoid um, markets that have any excess new supply or low barriers to entry. Um, for us, I'll give you an example. We're not fans of the Nevada or Florida states, not because those aren't great states. We just don't like um, what's gone on as far as the amount of building excess supply in those two specific regions. Um, I think that our ideal acquisition target would be something would be an undermanaged asset, a strong suburban feel, favorable demographics, limited near-term competition. Um, Also very important, assisted living and memory care are need-based. A doctor may say, you need to be here and you need to move fast. Independent living is a lifestyle choice. So when we look at new projects, we're not going to deal with older independent living communities. There's a lot on the market because it's the adult children are saying, I want something a little nicer for mom or dad. Um, the other thing, you asked a very big question, so I have to give you multiple answers. The other thing we're going to be very careful is post-COVID, several states adopted some very heavy regulatory environment when it came to coming out of COVID. Let me give you an example. In Pennsylvania, you have to have a full staff, whether you have one person in the building. So from an economic model, it's terrible. We need to staff this based on what our residents require, not necessarily what a state thinks we should be doing. So we'll be staying out of um, California, Ohio, Pennsylvania. Those are three that have recently adopted some very stringent rules that I think are excessive and unnecessary.
Gotcha. That all makes a lot of sense. Within your existing portfolio, where do you tend to see the best performance? Is it geographically driven? Are there other, kind of main drivers of success?
Yeah, I think it really is sort of a geographic area that we've decided isn't heavily competitive, where we can get high quality communities, strong demographic areas, and not have to pay, the typical ridiculous pricing. Let's say Beverly Hills, which would be anything like buying retail in Beverly Hills would be crazy. You can find good retail elsewhere. We're doing the same concept with the senior housing. So we're things like the Midwest. We've done exceptionally well in states such as Michigan, Missouri, Texas, um, Idaho, the Pacific Northwest, combination of, I would say, like your Oregon, Washington. Those are different pockets where we have multiple communities and very happy with what we're doing. Um, but the key driver of success remains the local leadership. Having a great executive director can make or break any of these communities.
And then I think at the alpha level, in terms of how we think about it, one thing we always say is that people need a place to live, they need a place to grow old, and senior housing, really hits both of those points, right? And as we think about, the environment, particularly supply demand, baby boomers are heading into these facilities in very large numbers for the reasons that you just discussed. There's an
Right.
supply of new product, and so if you can position yourself in the right markets with the right supply demand balance, like there's opportunities to be successful without having to, compete aggressively against the rest of the market. And then, I think what that also leads to on the acquisition side is, a relatively high cap rate acquisition environment, particularly compared to other real estate asset classes like multifamily. And, we'll talk a bit more about that, I'm sure, but it's a very fragmented mom and pop ownership base, and that creates opportunities for value creation, both by better acquisition pricing, but also through improved operations and growing your net operating income. So all in all, we really like this sector because it provides current cash flow on the acquisition side, and then also the potential to create upside, and that's oftentimes a very rare combination.
I would agree with you. Well put.
Thank you. And so as we move on, I do want to talk a bit about COVID because, even though it's in the rearview mirror, it did have probably an outsized impact on the senior housing asset class. And so can you just talk us through what operations looked like pre-COVID and kind of what happened and how you adapted during and after the pandemic?
Yes. Obviously, the COVID was very difficult time period for us. Both you're dealing with your own families, you're dealing with communities, seniors that are in a very dangerous situation, susceptible to any number of things that came up, COVID or other related. Your staff was having issues with COVID and was out. All those things put together, the whole world seemed like it turned upside down there for a period of time. I think we weathered it very well, but it became very quickly a 7 day a week job for a lot of us because we had to. But I would say pre-COVID, we focused on resident engagement and community life. During COVID, that flipped to infection control and isolation management. Post-COVID, we're both balancing safety is still paramount, but restoring socialization has been critical for occupancy recovery.
And then one thing we heard a lot about, particularly for the mom and pop operator, was the change in cost pressure, the growth in cost pressure that resulted from COVID, whether it was the cost of temporary labor going up or health and safety protocols, et cetera. What were the biggest cost challenges that you saw? How'd you manage through them?
I would say labor was our biggest issue without question. Wage inflation hit us hard, hit everyone hard. I think almost in all businesses. And where it became excessive was where so many people left the workforce. We were short. We saw that, McDonald's and some of these other places, fast foods were offering some large bonuses to entry level workers. We all had to compete with that. Um, where I think that so for us, when people don't show up, we had to engage an agency staff. An agency staff typically runs 3 times the normal rate during the height of COVID. Um, we, because of our culture and what we put in place and our benefit package, I think we were not immune, but I think we did better than most, which I was very happy with. Um, we've since focused on retention, internal training to reduce the reliance on the outside labor. On a secondary nature, food costs went up, insurance costs went up. Both those have, all three of those, so labor, food, insurance, have now stabilized.
And so would you say you're seeing any lasting effects, staffing, expenses, occupancy, things that have carried on, in this post-COVID environment?
Um, I think we all don't forget about what happened, and I don't think we can ever forget what we went through. But I think that, yes, probably some of our entry level positions are at a higher wage. The rents have had to go up, and I think people understand inflationary issues. Um, I think that we've done such a good job with our staff of being sort of being that group that has a culture of caring, both residents and staff. I think that has benefited. So whatever we've had to deal with, we've just had to, we've sort of said, look at that's reality and let's move on and make sure that our business models at all times reflects reality, not a wish list of what we thought, would like to have happen or what happened, 5 years ago.
Yep, that makes perfect sense. And have there been permanent changes in terms of how you operate or maybe how you think about future acquisitions? Like how has COVID changed the environment in that regard?
Yeah, I think on the operating side, we're more focused than ever on operator efficiency. I think it's very important about what we do. Our model has always been different than the industry in one, I think, very noticeable way. Typically, there's a whole series in your larger real estate investment trusts or large senior housing firms, a multiple layer of vice presidents, senior vice presidents, and the sort of a very vertically challenged. We don't subscribe to that model. We give the power to the executive directors, and most of our oversight, not all of it, but most of our oversight are more the player coaches. our best chefs have the ability to become sort of regional oversight and help some of the younger ones. Same thing goes with sales, finance, those areas. So I think that's where on the efficiency we do. I know all the executive directors there. It's not some big corporation that, sits in a white ivory tower. I think on the new deals, we're modeling with conservative lease-up timelines now. We're baking in higher baseline wages and realistic expense structures. And I think that discipline has helped us avoid some of the pitfalls that we've seen others hitting today.
And what I would add is, one of the things that we've noticed on the other side of COVID is that at an occupancy level, we're largely back to pre-COVID numbers. Expenses have stabilized, albeit at a higher level than pre-COVID. But I think most importantly is that a lot of these longtime owners, the mom and pops, their retirement is tied up in the value of the one or two assets that they own. And they're having challenges, given they're not as operationally focused as a group like Titan is. And because of that, I think they're looking to exit, and it's creating opportunities for groups like you and I who are trying to take advantage of the market dynamics. And so it's a long way of saying we think that on a going forward basis can be a very interesting acquisition environment. But let's take a step further and talk a bit about investment themes and strategy. And so, how do you think about risk-adjusted returns in senior housing compared to multifamily or maybe other real estate asset classes?
Well, I think senior housing offers significantly higher cap rates, often 200 to 300 basis points above multifamily. And we think the best returns within the senior housing come from fixing underperforming assets. That's where we can grow NOI quickly through smart expense management and better operations, and not some pie in the sky assumptions about leasing up at some much larger rental um, amounts.
And so you mentioned earlier that you prefer acquisitions over development. Talk a little bit more detail about why that's the case.
I'm not a developer. That's probably the easy answer. But within that, the reason I'm not is and you mentioned this earlier, is our model is we want good current cash flow with upside. With development, that's an 18-month zero income until you get to something. And I don't know what the world's going to look like in 18 months, but it's just uh, developers there's some great developers out there and they make very good money. It's just not what we do. So, and further, I think the development is very challenging in today's interest rates and construction costs. Take your in-place cash flow, even modest, gives you that more flexibility. You're locking in your lender early on, so you know what that is. There's not some great unknown that you're going to go out for a loan in 18 months, and where will the world be at that time? We don't know. So I think that is allows us to be successful.
And so let's actually talk a bit more about the debt piece, right? So, I know there's a preferred way to finance these deals, and we go through a pretty similar structure on most, but not all deals. Just talk a little bit about how you think about putting debt financing on these transactions.
Sure. Um, Senior housing debt is different than other real estate investment classes. Let me use a comparative model of, say, industrial. If you're buying an industrial building, you could go to your local bank, you go to regional bank, you could go to some of the agency lenders or insurance companies. You could get a bridge loan, you could do, if it's short-term hold. With senior housing, if you're, let's say, the first one you're going to buy, good luck. They realize that it is a asset class that requires skill and knowledge on the operating side. So most, like let's say your Fannie and Freddie HUD, are going to require you to have at least 300 units under management. So it's not comparative in the sense between industrial and senior housing on that respect. Right now, what we're looking for a medium to long-term hold. That's how we model it. When we do something different, we can talk about different exit strategies, but we typically will look for the most competitive terms in the market, which continue to be from Fannie, Freddie, and HUD. Those three dominate senior housing. So, given their slow nature to originate the loan, we have to go get a private bridge loan, some variable rate that Alpha and Titan have been very good. We lock it in with an interest rate cap, so we remove that unknown. Gives us about a 2 year window to get to the Fannie Freddie HUD. And those, to give you an instance, HUD is very competitive. Your interest rate will be about 6%. It's 35-year amortization. Um, Except for the headache of all the reporting, as you can imagine, to a government entity, that's cheap money. And it is, you lock that in and you have the ability then at some point in the future, let the next buyer can readily assume it.
Yep, that all makes a lot of sense. Let's talk quickly about underwriting. How do you underwrite a deal today compared to maybe what you were doing 5 years ago?
Um, I believe that we're underwriting more conservatively today. Labor costs, insurance, length of any lease up that's needed, all are under sort of a sharper lens. Um, but we also see seller expectations have been adjusted. And distressed deals are more common. Mom and pops. One thing I don't know if we discussed, senior housing is the only asset class that I know of where more than 50% of the base is owned by mom and pop individuals and not institutions. Um, that gives me a lot of, because I prefer not to buy from some very sharp tongued, Wall Street banks that have got the ability to access all kinds of data. I'd prefer to buy from a single mom and pop who built this, owned it, has got a very nice community and a good staff, but doesn't understand that what his NOI per occupied unit should be running at, what his food costs per person per day should be running at, that total labor should be percent of revenue. Doesn't have that. It's not important. They were running their operation with different, but that gives us an ability. So that's what we're going to look at as we call that. That's opportunity.
And so, as we think about the environment for new acquisitions, like we found it to be a pretty compelling moment in time right now, meaning, we're underwriting a lot of interesting transactions. And what do you think it is that is creating, this moment in time, these interesting opportunities?
Um, the demand would absolutely be number one, two, and three. So I would say that would be the amount of demand for our product let's just take the top three spots. Beyond that, we look for, now that we're operating, across the country, um, we know these markets and we immediately, if we haven't been to this other community, we're not taking a shot in the dark. We know exactly where we want to be. We know that on certain areas, we don't want to be on that side of the road. We don't want to be we will never buy a converted hotel that we see those a lot. They don't work out. We've seen what can go wrong. So having been in the business, there's some telltale signs that we can immediately remove. Beyond that, there's also um, the subset of brokers. Um, some of these smaller brokers, don't have access to larger players, so they throw it out to who they know. We're on their list, and therefore a lack of competition in acquisitions helps. Also, institutional investors have gotten in on the real estate investment trust, but they're not anywhere near the level of exposure that they are in multifamily, office, and industrial. So you don't have all these players. So you have a lot of demand. You still have a number of players acquisitions, but they're not as much as in other asset classes.
And I remember too, it was probably like 5 years ago now. We were at a conference in San Diego for senior housing, and in a room full of senior housing operators, and said, "How many are of you are acquiring assets right now?" And I think you and maybe one other person, raised their hands, and the rest of the room was developing at this point in time. And I think the reality is that, on the acquisition side, it is challenging right now if you're a group that owns one or two or three facilities to navigate, both the debt and equity capital markets. And a number of
Yeah,
times we just purchased a deal recently where we were what, the third highest bidder on the deal, and we got it because they felt confident that you could close. And so there's a lot of opportunities out there now. If we tried to buy 50 properties a year, I don't think we'd see the same profile of deal. But generally speaking, we're looking for four or five, and it allows us to cherry pick a bit.
I think you put it very well. I think that what we're trying to do is our strategy is to what we call buy onesies and twosies and assemble it into a large portfolio. And then some point in the future, a very large player could say, wow, I could get into this sector by writing one large check. I've now got a defined business. It's been seasoned. It looks good. All the work's been done. And therefore, as I would read it, is okay, then you're going to pay a premium for that.
Yeah, that's a great transition, right? Because when we talk about this being a good opportunity to acquire assets, the counter is, well, when will it be a good opportunity to sell these assets? And maybe you could just talk a little bit more about what an ideal portfolio exit looks like. Does the management company go along with those properties? Just a little bit more detail around that point.
Okay. So I think on the exit strategy, there's two ways to look at it. One is I already discussed it just a second ago. We talked about congregating into a large portfolio and having somebody write a compression, compress that cap rate because we did all the work for them. The other thing is there's nothing wrong with saying we could take our Idaho properties, take 8 to 10 of them, put them into a smaller portfolio and sell it to a regional player that really just wants, say, the Idaho. You could look at both those opportunities and you could always still sell one off if there was something compelling that you liked or you wanted to be out of that market. You did what you could. The rest of the portfolio you're still working on, got good cash flow. There's any number of ways you could do that to maximize the sale dollars. Um, Not only are we doing that alongside with the refinancings, we're doing our best to return some of the equity when we do these financings. So yields are getting juiced to a higher level, which everybody loves when you get to take chips off the table.
One thing we didn't talk about that I did want to, because it's an important part of what makes these deals interesting, at least from our perspective, right? Because we are transitioning to permanent financing, maybe it's 9, 12, 15, 18 months down the road, what have you, it does create an opportunity to create value during that initial stage before we transition to permanent financing. And then what
Yes,
happens, of course, is that, in many cases, we see pretty meaningful cash out refis where investors are taking anywhere from, at least with our portfolio with you, 30 to 100% of their equity, off the table, and obviously still maintaining their upside in the transaction. And that's a really interesting way to continue to compound your returns.
yes. Yeah, I would agree. I love it. I think it makes a lot of sense. Investors love it. And as an investor, um, anytime you can take chips off the table and continue to still get cash flow, works all day long.
Yeah, the other thing I would add, I would say in the last 6 to 12 months, every real estate conference I've gone to, there have really been two asset classes where institutional capital has expressed a lot of interest. One has been data centers, and the other has been senior housing. And, on the senior housing side, I think the challenge, as you mentioned before, is that, having, if you have a $500 million fund, I don't know how you go out and buy a bunch of 10 to $20 million assisted living facilities in Idaho or Oregon, right? Just the time to do that would take too long. You wouldn't be able to deploy
Right.
your fund in an efficient way. And so a lot of what we're doing here is acquiring these onesie twosies, as you call them, that we think make a ton of sense on a standalone basis. And then we're compiling them and package thing up so that institutional capital can come in, write one, you know, nine-figure check, and walk away with a cash flowing portfolio of senior housing assets.
Yes, agreed.
And so, as we think about the going forward, what do you think the next 3 to 5 years look like in this space?
Well, I think first of all, we expect strong tailwinds from demand. Um, Demand will continue rising. I see new supply will remain constrained because really where we are right now at the current construction costs, things are not penciling. You can't demand those kind of rents. Um, I think that we'll see more of what the mom and pops. There's a set number of mom and pops. Although we've recovered from COVID, we're back at stabilized occupancy. Um, that there's still capitulation. They're just done with the labor, the insurance, the food costs, everything they went through. I think that you'll see some people say, look, I'd like this high price. If you can get me a little bit less, fine, I'll take it. I'm done and I can go off into the sunset and enjoy my retirement. So I think that's what you'll see. I think that really when you look out to 5 years, I think my crystal ball is sort of cloudy. So much stuff is going on right now rapidly, whether in the politics and everything that how that relates to interest rates. We're we're optimistic yet cautious, and I think we're just going to reflect that in our underwriting of new deals.
Makes a ton of sense to me. And so, with that, just as a general closing thought, what advice would you give to investors who are, maybe considering investing in senior housing for the first time?
That's actually a very, very easy question. Partner with an experienced operator. This is not a passive real estate play. It's an operating business. The right team can turn a mediocre asset into a strong performer, and the wrong team can destroy value very quickly.
Kevin, thank you for the time today. Incredible insights. We really appreciate it. For anyone listening who wants to learn a bit more about our strategy with Titan or upcoming senior housing offerings, you can reach out to the Alpha Investing team. Otherwise, Kevin, thank you so much.
You're very welcome. Thanks, Daniel.